What's going on, traders? How we doing? Welcome back to none other than Stock Market Movers, where we keep the information in your edge and looking to go ahead and get to expert opinions. Today, we got another great show for you. We're going to talk about some topics like always. What's coming up this week? Oil falling, Ford, China and U.S. tariffs, Warren Buffett, and of course, we'll touch a little bit of Tesla. Can't forget Tesla. And also, I might throw in a little bit of Crocs in there. So I will let you guys know on today's show, we did have some call outs on some guests. So what we're going to do is we're actually going to be doing a little bit of some replays of the interviews from last week. But before we get into that, so don't miss it, guys. I know that you guys have the expectation of getting the news every single day here. And that's one thing I will not fail for you guys on. One thing I'm definitely going to be trying to do is getting you guys those expert opinions. Sometimes we might run into some scheduling issues. Today is going to be one of those days where I'm going to give you the headlines and then we'll get into some replays. So stick around at least for sure for the headlines so I can get you guys what's new on today. Smash the like button. Let's get it going here. Like always, hit the like and welcome to Money Mitch, Stock Market Movers. Let's go ahead. Let's jump on in.
It's time for Money Making Mitch. When investors need a story, we're going to the moon. Welcome to Money Mitch, where story is everything. I'm here to find you the next opportunity. It's all about the green hands. Now we all know the bull market is here to stay. Money Mitch.
All right, traders, how we doing on out there? And yes, SPY did make a little bit of a turn there and kind of hold in there. So let's go ahead. Let's dive on into that, see what we're seeing in the markets. We'll touch a bit about that when we get into it. First thing I want to do is touch some of the topics that we want to touch today. Like always, one of the things that we do is want to catch up with you guys on what to watch this week. So what to watch this week? Of course, we got the PMIs in the Euro area. We got Indian among others on Tuesday. So keep your eyes on some worldly kind of PMI numbers coming on out. But after that, really, one of the things that I'd watch today, U.S. factory orders, durable goods. Pay attention to that. FOMC minutes is going to be released on Wednesday. That's going to be massive. We also get U.S. PMIs, ISM services, and JOLTS job openings. Of course, on Thursday, you got to keep watch on crude oil. We'll talk a little bit of how oil's really been struggling here and really getting pulled back here. So the question is, are we seeing peak inflation? I think we just might be seeing it. At least that's what the prices are showing us. It could just be demand destruction, though, right? It could be demand destruction that's happening first, and then we'll see the peaking of inflation coming on in here. Another thing to keep on watch, Thursday, we got Federal Governor Christopher Waller and also St. Louis Fed President James Bullard scheduled to speak on Thursday. So just keep that on your radar. We all know how they like to talk a little bit ahead of the meeting. We'll take a look here. Also, ECB accounts for June policy meeting is on Thursday. And of course, on Friday, we get the U.S. employment, which is going to be massively important here, guys. We don't want to see the jobs going in the wrong direction. That will clearly show us what recession, as so many people are trying to talk to it. Of course, GDP isn't the only indicator that they watch, though. Economists really kind of focus more on the job strength there to see if we are actually going into a recession or not. I think we got to keep on watch to see what happens in this environment. But right now, everything is still saying recession. But of course, if we start seeing the peak of inflation, how does a true hawkish Fed really, does it change its tunes? Does it start showing a little bit of dovish action? We'll keep that on radar right here on Stock Market Movers. But like I said, yes, oil is moving on down right now. So let's talk a little bit about that. I do see some comments in the chat. I'll go ahead and I'll try to catch your comments on right now. But let's go ahead. Let's keep going. Let's take a look here at the overall market and what's going on in oil. So first thing I want to do is kind of share my screen with you guys so you guys can see the action I see right now. They got the SPY up right here. You can see how we bounced off of that 373.80 level right around there. We kept bouncing. We came down towards the bottom of the range. We've been seeing this happen often right now where the stock goes from the top to the bottom to the top to the bottom. And the SPY, you can see, has been pretty choppy. Even when we got that move on up, it's been a lot of chop on these SPY days, especially on the intraday action. So you got to be careful with that intraday action. You can see we had a little bit of a bounce. Let's see if we close above 373.64s. If not, we could test right back down there toward those levels. A lot of trappy on action out there in the SPYs. I want you guys to be on top of it. So like always, just understand what kind of environment you're in and what are you trading in is so important. Let's take a look at if there was any sectors that were strong this morning. So let's go. Let's take a look at the SPY here. What was hot? What was not? It looks like technology up on the day, actually 0.03, 0.4 on the day, but change from the open is pointing towards the upside. What was doing well? Well, let's take a look here. It looks like electronic gaming stocks did well today. Roblox leading the way there. Definitely seeing that nice little lift there. So keep that one on your radar. SE. Also, C Limited having a really great day, up there about 7%. You guys can watch other names like Skills, even getting a little bit of a lift today. EA getting into the green after I saw it in the red earlier today. Definitely pushing back up on there. Let's see how Activision is doing. ATVI. Nice recovery there. You guys can see it. Gaming stocks starting to get a little bit strong. This one has pulled back for a while now, has been sideways here. Going to look for some sustained action above 79 on Activision to maybe show us a move that it wants to get back towards 815. We'll see what happens on Activision, but definitely some relative strength there in gaming today. All right, now let's go towards the Ford headline. Ford stepping on in here, getting hit hard here off of this headline, not recovering some of those losses that we saw. And what did they say? Well, Ford down about, it was down about 1.8 here. Early on there, you got about 4% down. Then you got a little bit of a bounce. We're going to keep on watch Ford, but they said that sales rose 1.8% to 483,688 new vehicles in the second quarter compared to a year ago. But the expectations here were for it to rise between 3.3 and 5.1. This is missing badly here, guys. We're talking about 1.8 to 3.3 on the bottom line. And on the top end, that was 5.1. So really big miss there on the new vehicles for Ford. A lot of this coming, of course, on issues that we keep seeing. We heard early on, red flag from Toyota. Then we got red flag from Tesla. Then we got a red flag from some of the Chinese names. Then we got a red flag now from GM. Now another red flag from Ford. What does this do? They kind of lead, they follow each other, right? And I think this is why it's important to catch that early flag like we got in Toyota, letting us know that there was supply issues and material issues. And you guys can see Ford is struggling here. And they also did state, though, trying to point towards the upside here about their electric vehicles. Their electric vehicles jumped 76.6% from a year ago. But, I mean, I don't think this is really a positive news. I think this is just kind of a spin to make it look positive, but really we'll keep watching. It's only 4,353 vehicles, so that's not much. I mean, if you look at NIO's numbers, they beat that in a quarter, in a month, in June. So just keep this on watch. We'll see what happens. I'm not seeing the craziest action in those EVs, but of course, we need to keep on watch to see how this really develops in the long run. All right, we'll go ahead and see what happens. The problem is they're only looking at jobs as a gauge. Bad policy driving this economy. Yeah. You know, one of the things is Born, and what you're bringing up is kind of the focus on economists focusing if it's the jobs number or if it's GDP that's telling us that we're in a recession. And the big thing there is that normally in this environment, you start seeing that spike in the job numbers. So it's kind of like an expectation that economists are waiting to see if it happens or not, because that would be more along the guarantee that, yes, this is a recession. So people want some certainty. The certainty would probably come with that spike in the jobs number. And then from that point, people would be pointing more and more towards recession. All right, we'll see what happens on that. And DEFA spin, I would agree. I would agree. They're spinning that. They're spinning a lot of stuff right now, guys. So try to get around the spin. I'll give you guys the information, and you guys go ahead and determine if it's a spin or not for yourself. All right, let's keep going. Let's get through all the headlines today. I want to go towards the next one. We could talk about Chinese stocks and U.S. Keep these on radar. Let me take a look how Baba is doing on the day. Not looking too bad. Let's take a look at the daily chart here. We're going to keep watch these Chinese stocks to see if kind of the lift can come into these. Of course, there's multiple talks that U.S. and Chinese officials are holding discussions to roll back some of the trade levies that were imposed by former President Donald Trump. If that does happen, we could see a little bit of a push here, possibly in these Chinese stocks. So keep these on your radar. We've been talking about how strong they've been since that DD push. I still have it on the chart there. That's that circle right here. Ever since then, we've been bullish this. But like always, you got to be careful with China. Things can always turn around in a hurry. All right, now one thing they kind of mentioned here is the battle of oil, right? The battle of what's going on in oil stocks. We can take a look at some of these oil stocks. They've definitely been weak as of recent and weak on the day. You can see XOM coming down there towards the support. You can see Chevron definitely breaking down. Even Oxy, which Warren Buffett wanted to go ahead and continue adding. We'll talk a little bit about that. Warren Buffett said to have added another 9.9 million shares of Occidental Petroleum Corp, or otherwise ticker Oxy here, raising its stake to 17.4. So definitely Warren adding to winners. So you're going to hear often adding to winners. So he's stepping up to the plate and continuing to add there. One thing that I am going to go ahead and state, though, is there's a battle of analysts out there in oil, and we're going to continue to watch. Right now, as of recent, there was some kind of recent comments, right, by JPM and none other than Citi. Now we're seeing a little bit of a battle between them, as you're seeing one analyst say, JPM putting out a case for $380 a barrel. And then you got Citi coming in and saying that oil may collapse with a $65, with, of course, recession also coming on in there. So keep this on watch. We'll see what happens on oil. There's going to be a lot of movement that happens in oil. Right now, we're seeing the giant pullback, but is this the end? Something to keep on watch. We don't know. And like always, you got to keep on watch. Another thing that I want to go ahead and state here is Tesla. Let's get into Tesla. How is it performing right now on the intraday? Let's take a look here. Tesla finding a little bit of a bounce here around the 680s. I was watching it go through the VWAP here, was looking for a long, and they held here. So it's up there now towards 680, about 3% up there above the close. Want to see that continue, but the daily chart still has it in the bearish sense. It needs to get back above 750 for us to really get bullish. If not, it could break 650 and head towards the 600. Now, what happened with the production numbers? Let's go ahead. Let's give you guys those production numbers here. Tesla announced Q2 total production of 258,580 units, total deliveries of 254,695 units. On a year-over-year basis, the second quarter deliveries were actually up 26.5. But if you look at it compared to Q1, you'll see that they dropped the ball there. We'll continue to watch to see how this production continues. Of course, this production could have got hit hard because of what was going on in Shanghai. But analysts were looking for anything above 260,000 units would be viewed positively. Looks like we're getting a little bit of a positive push here today. We'll look to see if Tesla can continue. Last one I want to get into is Crocs. Yes, I said it, CROX here. Crocs trying to make another leap on up. So we're going to continue watching this one. This happens after Loop Capital upgraded Crocs to buy from hold. So this is coming off of a rating. I don't know about you guys. You guys in the chat, let me know, guys. Do you guys own a pair of Crocs? And how do you guys feel about it? You're bullish on the Crocs or bearish on the Crocs? I don't know, man. I don't know if people are really buying Crocs in this environment, but who knows? Maybe Crocs is finally finding a bottom there. I'm not the one because I probably never owned Crocs and probably never will. But hey, to each his own. If you like the shoes or you like them or you think you're comfortable, let me know in the chat. we'll go ahead and cover it. All right, guys, that's going to do it for headlines. There's still a lot going on in the market. So if anything stands out to you while we're doing some of these interviews, of course, smash the like. Let me know in the comments. Another thing that I want to do here is I'm going to play some of the interviews from last week, but I want to watch out because my questions normally aren't towards right now in one day. It's normally a forward-looking question. Let's see how it's changed from the interview to where we're at, and also compare analysts, as you're going to see multiple people here probably talk about the same thing. Let's see if there's anything that we can grab watching this. Is there anything that they're kind of rhyming to that each of them are bringing up to keep on watch? This is something that we all should kind of keep on watch. I'm going to watch these with you guys. So talk about it in the comments. Let me know what you guys think of these questions. Let me know how you think of the answers. This is where we can go ahead and have a deeper conversation. You guys want to talk to me? I'll be in the chat. Let's go ahead and start some of these videos. I'm going to go ahead and get some of these ready here. So first up, we're going to get into, of course, Adam Johnson here. I'm going to go ahead and get into Adam Johnson. This is going to be from Monday last week. Let's go ahead and dive on into Adam Johnson's interview. And then we're going to just keep it going. You guys, I'm going to try to keep my best to keep the flow going and get into all the interviews. But like always, there's too many to get into. So you guys might see me shorten one a little bit as I feel like it's just not as catchy. And then we'll just keep moving forward. All right. You guys in the chat, let me know what you guys see. And if you guys have any comments about these interviews. All right. So first one first, let me get this ready here. Boom, boom. All right. Let's do this. So let's go ahead. Let's bring on Adam Johnson here. Welcome to the show, Adam Johnson. This is the portfolio manager and advisor investments and also American Ingenuity Strategy. How we doing, AJ?
Hey, doing great, Money Mitch. It's great to be with you. It's been, I don't know, a few months. You're right. It's been too long, but you know, I think we've all been kind of hibernating, just trying to survive. I think the good news is we're coming through this whole thing. I think the 2 E's of earnings and employment matter more than the 2 R's of rates and recession. So it's good to be back. There may be some red on the screen today, but I think the future is a lot more green.
I'll tell you what, Adam, I've been watching your interviews also. It's not like if they're not on here, I don't watch them. So I will get into some of the things that I've been watching you mentioned. Let's talk about the market bottoming out and what are the 9 signals that you use? I've heard you mention these before, and what should we look out for?
Yeah, it's the checklist. I call it the Are We There checklist. And Mitch, I've been able to check about 7 of them. Just to keep it simple, think about stuff like this. The percentage of stocks in the S&P 500 below the 20-day moving average, that's 98%. The percentage of stocks below the 3-month moving average, that's 95%. Anytime you get either one of those percentages above 75, that's a washout. And again, we're at 98 and 95. So check 2 items off that list. You look at the ratio of bears to bulls. Right now, it's about 3 or 3.5 to 1. It actually was as wide as 4 to 1. That was the most negative since 2008. And anytime you get it above 3 to 1, again, that's something else you can check. Again, that's something else you can check. The volatility index inverted. It's been inverted for months. Again, something we can check. 7 of 9 items on the AJ Are We There Yet checklist, I've been able to check off, Mitch. The 2 I haven't, the VIX, the volatility index, I know it's inverted, but I actually like to see it go above 40, where you get that ultimate sell-off and everyone just says, get me out. And then the other thing, which is related, is the put call ratio. You get that above 1.4, it's gotten to 1.36, which is close. And again, that's just telling you that there's total capitulation. So 7 of my 9 I can check off. The VIX and the put call, I can't quite, but
wonder what Adam would say today. We're going to keep on watching. Yeah, it seems like we've been having recent relief rallies. A lot of question on out there. If this is one of those, I would like to ask you, how do you feel about today in the bottom put in or not? And of course, what should we watch to see if we do get that bottoming action? Of course, there's the 2 that you mentioned there that you're keeping an eye out for.
Yep.
But what if we don't get those? Would that still be kind of a mode where you'd be like, well, then I'm not going to go fully in on calling the bottom here?
Well, admittedly, I don't think there's any money to be made in fully calling the bottom. There is money to be made in picking high quality stocks that are down on the lows and owning them over the next year or two. I'm an investor. In fact, if I need to wait 3 or 4 years, I'm happy to do that. I'm not a trader, so I'm not going to try to tell you the bottom's in, there it was. What I will tell you is that I have been buying. I do believe that bottoming is a process, and we are well into that process. Now, if you think, Mitch, about what happened or has happened over the past several months, first it was all the growth stocks, all the Kathy Wood ARK ETF growth stocks that got crushed. Then it was the FANG stocks, starting with Amazon, then Facebook, et cetera. Even Google and Apple have gotten hit. Netflix, no need to go into that one. Nvidia, et cetera. And then it started to rotate through to industrials. And then the banks made new 52-week lows. And then if you remember when Target blew up about a month ago, the retailers all got crushed. Bitcoin over the past couple of weeks. So my point is there's been this rolling bottom in the market. And even though in the past, what we've typically seen is everything go down and make a low together, in this particular sell-off, this particular bear market, it's not unfolding that way. It's, as I say, this kind of rolling bear market. So I'm not sure we're necessarily going to get the one crazy day where everything looks horrible. But I will tell you, Mitch, there have been, as you know, a lot of crazy days. And 2 weeks ago, when we were down, 12% over 4 trading sessions, that felt pretty crazy and pretty ugly. I did some buying. I'd rather be buying in here than selling in here. So I can't answer your question. I can't tell you definitively the bottom is in. All I can tell you is what I'm doing, and I'm buying.
All right, there you guys hear Adam Johnson. Check out Adam Johnson. He's on all the major networks. He's on Fox Business all the time, so check him on out. He definitely giving us some good insight there and saying that the bottom is a process, right? It's not just one exact way there on it. So I think that's something definitely to keep on watch. Let's go ahead. Let's get into the next video here. This is going to be Sam Stovall. Let's go ahead. Let's dive on in here. Let me try to get him right into the interview here versus the startup here. Let's go ahead. Boom. Get you guys going here. Sam Stovall, the Chief Investment Strategist of cboe. All right, here we go. Research. Welcome to the show and glad to have you back.
Thanks. Happy to be here.
Definitely. Now, of course, what this show is really all about is trying to get to the experts. And of course, like I mentioned before, this isn't financial advice for educational purposes, but let's dive on in. First question I want to ask about, is the bottom in, or are we just in kind of a relief rally? What do you see, Sam?
I think that we're in a relief rally because like you and like the people who are watching, I'm really just trying to learn from what the market is telling me. And what I have found is that traditionally, when we do end up seeing the market sell off, especially if we have very, very little participation to the upside, through the most recent low, none of the 150 industries in the S&P 1500 were above their 10-week or 50-day moving average. And that is usually only seen toward the end of declines of 15% or more, going back to 1990. So it tells us that we're probably near a low, but a lot of times we bounce along the bottom before the actual low is put in place. And we have yet to have a true capitulation, in my opinion.
Definitely a good number to keep on watch. I've heard you mention that 10-week multiple times, something that I'm definitely keeping an eye out. I'll already cross out a question that I had on market breadth and strength in certain industries, but you guys can see there, Sam already answering that. Let's talk about what there is to watch this week for further developments. What should we keep our eyes on open to?
Well, I think this is going to be sort of a limbo week as well as next week, because it is surrounded by the 4th of July holiday. So we will have probably less volume, fewer traders that are actually involved. And I think what's really going on is investors are wondering what is going to happen to second quarter earnings as well as second, third, fourth quarter guidance, because usually in a recession, we tend to see earnings come down. We really haven't seen that yet. 2022 earnings are expected to be up 8.8%. Next year, it's supposed to be up 9.3%. We have seen a little bit of downside revision for the second quarter. So I think we have to wait to see what the second quarter indeed brings, as well as what the forward guidance might be, because we traditionally see a 1/3 trimming of the PE ratio during bear markets associated with recessions. And right now that has not happened.
Perfect. It's exactly what I was going to be pointing to in my next question about revisions on earnings, because I think that's definitely the next signal to show us what inning we're really in the bear market, right? Is this kind of early and we're seeing the swing already, or do we continue to see some earnings outlook, especially on the overall market, to see that kind of getting hit towards the downside? But what do you need to see, Sam, for you to call the bear markets over?
Well, I monitor my own level of capitulation. It's very simple. I just download daily intraday prices. You can get that for free online. So intraday high versus the intraday low, whatever that percentage is. And then I plot out a rolling 15-day. And what you'll find, very interestingly, is a very sharp spike, like a stalagmite that breaks above 2 standard deviations from the mean. Basically, you can tell it's like a very sharp upward heartbeat. And usually once we get that elevated peak and then it starts to come down, we are very close to that sell-off bottom. So once, in a sense, investors have said, I've had enough, I don't want this anymore, let me sell everything, even if it is a good quality stock, that's usually the time to go in and start to pick up what's left.
Now, one area that I'm keeping on watch, of course, is right, guys, I'm going to keep us going here. I'm going to move a little bit forward here. We're getting some more insights. So let's keep watching on how this develops, right? This was Monday of last week. Let's bring on the next guest and continue the flow here. I think important comments made by Sam there that he's looking for at least that full capitulation low there to show him the signal to get back on up. Let's go ahead. Let's get into the next interview here. We're going to dive on into Lance Roberts here. Lance Roberts is a great follow. I definitely would tell you guys to check him on out. And he also does often a YouTube show in the morning, so you guys can check that on out. But let's go ahead. Let's dive on in here with Lance. And glad to have you finally on Stock Market Movers.
Glad to be here.
Excited to go ahead and get into it. You guys see the action going on in the background there. I always go on to RIA Advisors, and you guys can check out some of the content they do. Either it's on their YouTube or it's articles getting put out. I would definitely check them out. Description down below will get you to it. But let's jump right into it, Lance. We're seeing a little bit of a cooling off action today. Now, the question I come to you is this more of what we've seen in a relief rally, or is this more along the lines of, you think, a bottoming action that we saw?
It's too early to call a bottom right now. And the reason is that, as we look at where we are, this week in particular, this is the end of the quarter for the second quarter. So we've got a lot of rebalancing going on inside of portfolios, $30 billion to be, rough kind of round numbers for this week. Moving into July. Now, July tends to be seasonally a little bit stronger month. And look, we've had a couple of really tough months. May was a tough month, and the only reason the returns weren't more negative in May is because we had a last week rally in May that basically wiped out all the losses for May. June is kind of stacking up that same way right now. So again, if this market can kind of rally over the next couple of days, might pair some of these losses for the month. But like I said, July tends to be a little bit better. August and September, those are months that we need to worry a little bit more about as we get into kind of the seasonally slow period of the markets, and particularly moving into the end of the year. The big issues here right now that the markets are struggling with. Yesterday, you had the Dallas Fed Regional Manufacturing Index come out showing very sharp slowdown, not just in the actual headline index, but in new orders, expected new orders, prices paid, all taking very big downturns. That's going to lead to more recessionary talk here over the next couple of months. Today, the Richmond Fed, exactly the same thing. I mean, across the board, when we look at indicators economically, they're all pointing to fairly sharp, substantial slowdowns in the economy. Now, this is deflationary. And we talked about earlier this year that this inflation push we're going to have is going to be temporary because high prices will solve high prices. And now we're seeing that process come through the markets.
Perfect. I think you're hitting it on the nail here. Let's start talking about inflation. What are you looking at in, let's say, the next 3 months? How do you see inflation playing out? Do you see a topping already, or maybe you could see topping coming? What do you
Well,
see?
it's going to be, and so the interesting thing about inflation is if you go back and look at history, whenever you have more than a 5% annualized rate of change in inflation, and we're currently about 8.6, 8.7, that is typically, well, it has, all going back to 1960, always preceded a recession. So when you have a recession, you have a very sharp contraction in inflation. Now, this is the interesting thing about inflation. Inflation doesn't just move up and then kind of gradually come down over time. It's straight up and straight down. There's a very sharp decline because of the recessionary impact that is set by a slowing economy. Now, let me just clarify one thing. I'm not saying we're going to have a recession. There's lots of talk right now that a recession is inevitable. And as you and I both know, there's only 3 things in this world that are inevitable. It's death, taxes, and Thanos. Outside of that, pretty much everything has a possibility of, not doing exactly what we think. So could we just have a slowdown, a very short-lived kind of temporary pullback, and then the economy start growing again? Sure, it's possible. However, given how we got here, the reason we have inflation, $5 trillion worth of liquidity, you shut down the economy, you had all this demand, no supply. And as you were just talking about a moment ago, now all these companies have gone back, previously have run in and built up all this inventory. Now nobody has any money to spend. So now these manufacturers and producers have to liquidate this inventory, which means that going upstream, all the orders for commodities, any type of input good that goes into manufacturing a product that you buy at Target or Walmart, are also going to see slowdown in orders. So this is what we call a bullwhip effect. We had the bullwhip. So if you think about how bullwhip works, right? I whip my wrist, the bullwhip goes out, cracks at the end, and comes flying right back at my face. So we had all this liquidity. That was the bullwhip going out. Now the reversal of that is no liquidity. All that's got to come back in the other direction very quickly. So you're going to have a very sharp downturn in inflation. Problem is, for the Fed, is they're going to get trapped very quickly between trying to hike rates and slow the economy and trying to combat a recession.
Yeah. Great answer there by Lance Roberts there about bullwhip effect. I tell you guys, definitely take a look into that. Take a look into what really goes on when you have a bullwhip effect, right? He tried to explain it there, but I think you guys as investors out there want to go ahead and learn some new kind of skills. I would take a look into what bullwhip effects are and how they have an effect on the economy overall. I think this is important to kind of keep on watch. Of course, he also mentioned on demand destruction and how prices could just get knocked back down. Of course, with that demand, as the prices rise, eventually the demand kind of falls down there and brings the prices back down. So keep this on watch. Let's go ahead. Let's get into our next. That leads exactly to the question. Just give me 1 second here. Let me get into our next one here. Let's go towards Jay Hatfield. So it's going to be an interesting one here. All right, let's go ahead. Let's jump on in here for us there. Let me get it to a good spot here. There we go. All right, let me go ahead and bring this on in here for us. There to help the retail traders out there. So thank you for coming on. Like always, guys, this isn't financial advice for educational purposes only, but let's go ahead and dive right into this. So, of course, there's a lot going on right now. One of the first kind of questions that started off, let's keep it basic. How do you see the market sentiment right now and overall kind of moving?
Well, Mitch, what we've been looking for is as a catalyst to stabilize the market is for treasury bonds to stabilize, which we've been saying it would happen around 3%. It's probably better to say 3.5, 3 to 3.25%. But we've seen that stability start to set in. And the reason that's critical is that's the biggest input to coming up with a fair value on the S&P. So right now, at today's interest rate, our fair value estimate is about 4,200. So it means we're about 10% cheap. So that if treasuries hang in where they are now, that'll be support for the market. We did see the market bounce at 3,700. We're at we're trying to hang in here at 3,800. But keep in mind, and this is probably the most important point that I can make, is that generally speaking, you want to be in the market when companies are reporting earnings, and you want to be cautious or out of it or hedged or have some cash when they're not. Because when they're not, hedge funds tend to short the stocks. They don't have to be worried about any announcements coming from the company. And so we've had the kind of the normal, even though this has been a bad market this year, it's pretty normal to have a weak June, a weak September. Those are the months before the companies report.
Excellent. Something definitely to keep on watch there is how we kind of continue out here. Now, one thing I did see is a tweet by InfraCap. So if you guys want to follow that, that's all that's the tweets coming from Infrastructure Capital Advisors. Check that on out. I put it up in our tweet. You guys put out a tweet that said the Fed executed 136 billion of quantitative tightening last week. So let's go into a little bit more of that understanding on the Fed and quantitative tightening. What is happening here and how is it having an effect on commodities?
Well, first of all, Mitch, that's a fabulous question because really almost no investors are focusing on this dynamic. It's a little bit complicated, but it's worth mastering even for retail investors. And that is that the Fed can control what's called the monetary base, which is really just money, regardless of how many securities they're purchasing. So they purchased 9 trillion, but they offset about 2.5 trillion of that through what's called open market operations, which is how they used to control interest rates. So you would have thought, if you just listened to the news and the Fed, that they were being completely irrational and buying securities when we have this inflation, but actually they were offsetting that. In fact, they've offset it so much this year that they've shrunk the money supply, or really just money, simple way to think about it, by $950 billion. And we think that's the critical dynamic. You mentioned crypto. I don't know if we said it on the show, but we have had a 20,000 target for crypto, but not now when it was at 3,500 and 40,000, 35,000 and 40,000. And the reason for that is so when the Fed sucks cash out of the capital markets, it tends to deflate all securities, but the riskiest ones the most. So that's why you've seen profitless tech, meme stocks, crypto get completely smashed, crash really. Altcoins are down like almost 90%. So you don't want to be in the highest risk assets when the Fed is taking that capital out of the markets. Sort of the opposite of during the pandemic, they announced they were going to intervene. That was the perfect time to come back in the market. That was basically the bottom of the market, about 2,200 in S&P. So I would urge you can follow us on InfraCap, or you can do it yourself. It's H.4.1. and look at the Fed's balance sheet. I've been doing it since I was in college, so you can rely on me to put that out as a tweet. But if you do that, you'll be ahead of 99.9% of investors because they're not focused on the Fed's balance sheet, but it's absolutely critical. And to the extent they have the ability to accelerate that, taking capital out or slow it down. So it needs to be watched every week.
100%, Jay. I would
Great answer there by none other than Jay Hatfield. So check that on out, guys. I don't know if you guys caught that, but I thought that was really important how he talked about not fighting the Fed, right? And he also talked about how when the Fed is going to that tightening, that of course the riskiest assets would probably get hit the most. And the opposite was in the pandemic, was when the money came easier, the riskier stocks would get that boost. Given some definitely some gold there. Let's keep it going here. Let's go towards the next interview that same day where we talked to Jay Woods right out the New York Stock Exchange. So super excited to get into this. Let's go ahead. Let's dive into it with none other than Jay Woods right on the floor. So let's go ahead. Just put this full screen here.
A lot
I'll
of
bring him back
action
on.
going on around you. Let's first talk about getting into what this end of the month can look like and why we're maybe seeing a lot of choppy action out there.
Yeah, we've had a few events here. It's been an interesting June. We had the Quad Witch 2 Fridays ago. Last Friday, the Russell Reconstitution, the third busiest day in the history of this fine institution. And then, Thursday, which is going to feel like a Friday to a lot of people. I have a feeling Friday's going to be very slow. Sadly, I will be working, but this Thursday is the end of the quarter, end of the month, and end of the first half of the year. So you're going to see some window dressing. You're going to see some portfolio managers trying to jump into names. Maybe they weren't in, and they're just going to say, oh, yeah, look, I was in on this name by the end of the year, or by the end of the quarter, by the end of the half year, that is. And, we'll probably see a nice spike in volume. Nothing like we saw the last 2 Fridays, but it's always interesting. And then what we're going to do is we're going to talk about second half prognostications, tough word for me to say. And, a little bit of a look back to the first half, because it was a rough one, unless you were in energy, of course.
Yeah, definitely. So what's going to be on your radar for Q3? What should we kind of keep on our radar?
I listened to you, and you've done this to me twice now. You went into some areas that I wanted to focus on.
We'll touch them. We'll touch them. Don't worry. I always got some
you're
questions
stealing
for
my thunder.
you.
I don't want to repeat some of the great things you were talking about.
Like always, one of the things that is important is staying with the relative strength, right? And I think I talk about that always is if you can
without
stay with
a doubt. And you mentioned 2 sectors that I have my eye on: healthcare and biotech. Biotech has stopped going down, and in this market environment, stop going down is better than the stairs we continue to see month to month to month on the downside in the major indexes. So you look at the IBB and the XBI, and that could be a double bottom. We're starting to see some strength there. And then let's look under the hood a little bit. Biogen is a company that I don't know if you mentioned before I jumped on BIIB, but all right, we're seeing some technical progress. It's been one of the most beaten down sectors, in the last year and a half prior to the real big sell-off in the S&P. And I'm starting to see some green shoots there. In the biotech sector, there were 3 that jumped at me, like little names. I don't even know what these companies do, but from a technical point of view, Ionis, IONS, Meridian, symbol VIVO, and then Harmony, HRMY, which is, I looked it up, they're from my home area in the Philadelphia area, so they get extra points for that. But these are 3 little stocks in the sector that are starting to, from a relative basis, acting extremely well. And from a technical basis, we're knocking on new highs, and that's what I like to see. And then you talked about 3 of these stocks before I jumped on in the healthcare space. We got new highs. I like to look at that new high list, and it's not energy names just making new highs. It's not Warren Buffett's Occidental, which is taking a little bit of a haircut recently. It's what are we looking at? We're looking at Merck. We're looking at Eli Lilly. We're looking at Bristol Myers, as Kramer, one of Kramer's favorites. Pfizer acting okay. They're not the most exciting names, and the space I think is down 8% year to date. But if you're looking for stocks from a relative basis that are starting to outperform and turning up, I think biotech and healthcare are some of the areas that you want to focus on.
Definitely something to always kind of watch. We're always looking to find a kind of where's the rotation going, or where is the puck going. That's always the kind of question that you want. It's not where it's at now, it's where it's going, right? And so let's talk a little bit about, let's get into some micro action. I did see recently, Nike earnings, and it wasn't that bad. It beat on EPS and revenue. Where do you see Nike overall in retail?
Well, Nike, and this is one of the things we talked about down here, that is such an iconic global brand. And, their guidance, they were one of the first to guide and worry about supply chain issues 6, maybe 9 months ago. And you can see it in the chart when it started to really break down. The guidance was what we were focused on. Again, yes, it was great that they beat on numbers. They did guide a little lower, and they beat on those lower expectations. So that's a positive. The reaction from a price standpoint, that 103.5, 104 level, and I'm glad you have the chart up here. It's fighting to hold it right now. We broke down yesterday, new 52-week low. I think we hit it again today, another 52-week low. From a risk-reward point of view, I think it could be a good entry if we can get that close above 103.5, 104 with a quick and a tight stop if it does break down. And what do? We're going to rally a bear market rally. And this is what we continue to hear as a topic, as a theme across all sectors. But in a bear market rally, we've seen 5, 10, 15% rallies in individual names quickly. And this now is set up from a short-term perspective to possibly give you that quick 5 to 10, maybe 15% back to the 50-day moving average, 117. So it's there where I like to see setups from a day trading, swing trading point of view. That okay, this thing breaks another dollar. You know what? I'm getting out. I'm cut my losses. We'll revisit it again when it's on my side. But once again, longer term, it's in a downtrend. No one likes to trade stocks under the 200-day moving average in a downtrend. But it could be an interesting spot to nibble.
Something definitely to keep on watch. I think we all are looking for some kind of plays, right? And we have to keep this in mind. There is going to be some great opportunities that come out of this bear market. So I think it's something that everybody should keep on watch. Now, let's get into kind of one of those headlines that came this morning that I'm sure it knocked a couple people off their socks. Was Morgan Stanley's analyst, Jamie Rollo, stepping up to the plate with his zero bear case for Carnival Cruise Line. What do you think about that? The crazy kind of bear case to zero on Carnival Cruise Line.
That was an aggressive call. And yeah, I mean, they have a lot of debt on the balance sheet. Right now, we know the travel stocks, from the people going to travel, they're acting phenomenal. The log jams at the airport, the flight cancellations, cruises, people are getting back out, they're doing things, but will that translate over the longer term? Will that be able to withstand another, as they said in the Morgan note, another, catastrophic event like a second wave, third wave? I don't know what wave we're on in COVID, but, can they withstand it? And right now, price action is telling me this isn't good. Carnival Cruise Line is about to test the COVID lows when the world was coming to an end. We're back out there traveling. We're back out there on these ships. So there's more to it. And it was a bold call. But, I'm a technician at heart first. I know that people are traveling. I know what's going on, but the market is a leading indicator and something ain't right here. And the price action, if this doesn't hold that $8, I think 27-cent low from the COVID low, I wouldn't be rushing to put money back. We're not in that day trade era where people are they're going to travel. They're going to get back on ships. Okay, we're doing it right now. What happens come September when people are like, all right, the COVID fatigue is over. I got that trip that I've been waiting for out of the way. And yeah, now we got to cut back on expenses. All right, we're not going to take the next trip.
There you guys see Jay Woods bringing in some great information there. I think it's so important to kind of keep on watch what happens really when we start shifting on over out of summer, going into fall and winter, right? How will the spending be? You're just going to see it cut off? Are you going to see the consumer just completely say enough's enough and I'm not spending anymore? I think that's one thing that we got to keep on watch to see what happens with the cruise lines and the airlines. Of course, airlines can get a little bit more around this because people still need to fly, right? I mean, let's just be honest. If you need to fly and you need to get to A and B, more than likely you're not thinking about driving there because also the fuel prices, right? And so we'll keep on watch to see what happens. Cruise lines are a little bit more into that tourism kind of look. It's not a need, a necessity. It's kind of more of a want. And so we'll see how they kind of perform in this time. But I do think that you're going to see kind of maybe bookings fall off, and that could even lead to continued downside in these cruises. So good mention there by Jay Woods, New York executive floor governor and chief market strategist at Drive Wealth. Let's keep going here. Let's get into the last one here. We're going to go into Sal Gilbertie here. Definitely important to kind of touch here just because at the end of the day, one of the things that we want to do is definitely stay up also on what? On the commodities. And that's why we have commodity experts here like Sal Gilbertie here from 2 Trading. Let's go ahead. Let's dive on in and learn a little bit about, of course, about some commodity action here. CEO of 2 Trading. If you guys want to check out some of these ETFs, I definitely tell you guys to take a look. I love that he always has it in his background too. You guys can see it there. Corn, soybean, wheat, cane. Check some of these out. We're going to go ahead and start diving on in. But first, wanted to say thank you for joining me, Sal.
It's always a pleasure to be here. It's good fun.
Definitely. First thing I want to do is start off right off the back and give you guys some props because as you guys can, and you guys investors out there, I'll tell you guys to take a look at that 2022 grain outlook that you guys put in the beginning of the year, where you guys were stating that you were expecting inventories to build this year. Explain why this is the case
And do you still see this as the case in 2022?
Well, we do. And the reason is that high prices fix high prices in commodities, and farmers are planting as much as they possibly can. And so what's happened here is we've had a couple of years before the war. You had 2 years where, depending which commodity you looked at, corn, soybeans, or wheat, each of them had a 2 out of that 3-year period, different years during those times, where we actually used globally more than we produced. So you have a shrinking balance sheet. And if you just think about it, grains are an essential part of life. You have to eat them to survive, and they're used for fuel now. They're integrated into vital parts of the economy that people can't live without. It's kind of not optional to use these grains. And so if you have a supply disruption of any kind, or you have increase in demand, which demand has increased every single year, the combined use of corn, soybeans, and wheat since 1960 has either been a global record or the second highest every single year, bar none. And so, because global population is rising, because uses for these things are getting more varied and growing, you see demand going up all the time, year after year. And crops are dependent upon weather largely. And then we had the war. So prior to the war, you had the balance sheet shrinking, and only slightly, but it only takes a little bit in order for people to get really nervous about there not being enough food. So that's why you saw prices kind of creeping up 2 years prior to the war. Once the war came, of course, wheat prices led the way with all that wheat locked in Russia and Ukraine. And you saw the tremendous outperformance of grains versus just about every other asset class out there.
Yeah, unfortunately, I don't think we could be like the dogs out there and go full grain free. So we won't be doing that. But one thing that I do want to talk about is that we have seen a little bit of a hard turn around in commodities. A lot of this coming in different areas. Let's focus first on wheat. We have seen it retrace from its highs in May. Now, why do you think this is happening? And is this just more of a correction, or do you see continued downside here?
Well, I think it's a little of both. I think that, number one, markets, when you have tremendous events like this, like the war, markets price in the extreme almost immediately. And so the market's priced in the total loss of all the grain in Ukraine and the total loss of all of Russian exports. We may, the jury's still out. We may lose most of the grain in the Ukraine because they can't get it out. You have to get it out by ship. And, people putting their hopes on rail and storage, and that's pretty much nonsense. It's not going to happen in enough volume or enough time to save that grain. But Russia's wheat is there. It can be shipped. There are no penalties for buying Russian wheat or fertilizer. The world knows that people need both those things. And so Russia can sell those things. They're not lost to the world. And I think everything calmed down. People realized that we had the maximum damage priced in. The maximum damage isn't going to occur, meaning we're not going to lose Russia's wheat as well. That will be available to the world. And so you see this retracement. You also have a natural seasonal retracement in grains. Every year, as the Northern Hemisphere's planting season ends and you get into growing season, which is right now, the thick of it, you tend to see grains stop moving up because it's a seasonal tendency where people aren't nervous anymore. The crop's in the field, they can see it growing, they're a little more comfortable. Come autumn, we'll have enough supplies to replenish what we've used over the prior year. So we're seeing a seasonal decline. The highs may be in. They may indeed be in. I mean, we could have drought. Much of the Corn Belt is experiencing drought. The next 4 weeks are really critical for rain in the right places, or you will have reduced yields in the Northern Hemisphere, and that's a very big deal and bears close watching. But by and large, I think the panic buying that brought us to the highs that we've seen, multi-decade highs in essence, I think that's done with.
Something to keep on watch. We'll see if we get back to those May highs. But now let's shift on over, of course, to the Russian invasion and what's going on here. I think the important question, of course, is will Russia continue to kind of blockade the Ukrainian grain exports here as a bargaining chip and continue to use kind of the situation that's going on here to try to continue to get some of these sanctions back? What do you think?
I think they will. They have no intention of letting Ukrainian wheat out. That would strengthen Ukraine. It's virtually impossible right now anyway. If while we're speaking, the leaders of all the countries, including Russia and Ukraine, announced that a deal was reached and they're going to release all the grain, it will take them months to demine the ports where they're shipped out of. There's a lot of damage. The Russians have actually bombed some freight elevators and grain grain elevators and grain processing facilities there at the ports. You're going to lose last year's crop, which is there. This year's crop, which is being harvested now. They really don't have anywhere to put it. Ukraine is in danger of losing much of last year's and the current year's crop. But again, Russia's having record or near record production. They supply, they're the world's largest wheat exporter, and they have plenty of wheat to export. So I don't think Russia's going to let go its grip on Ukraine. I wouldn't count on anything coming out of Ukraine in volume at all. It's just a myth.
All right, you guys getting some information there from Sal Gilbertie. If you guys didn't catch all these interviews, I would definitely tell you to go back and check them in their entirety. Of course, we're going to keep going to experts on stock market movers, but I wanted to do a weekly recap. Check how you guys thought about what we got last week. A lot of experts giving us a lot of insight. We went from the beginning and Adam Johnson talking about what is he looking for bottoming, and that bottoming is the process, all the way into commodities talk here with Sal. There's a lot always going to be going on in stock market movers, so I want you guys to catch it live, but that doesn't mean that you guys have to always catch it live. Catch these interviews also after. Really catch from the experts, because they're going to be dropping little hints of gold throughout their interviews for you guys to stay in the informational edge. Hope you guys enjoyed today's show and was able to get to at least a recap of some really great interviews from last week. Unfortunately, we had some call outs for our guests on today, but I'll make sure that we have some guests on tomorrow. You guys give me a big old thumbs on up in the chat below. Let me know what you guys thought, and maybe one of these guests was your favorite. Who was it? Which interview got to you the most? And that's always important, is how it hits you. So let me know in the comments, and I'll definitely go ahead and keep bringing them back on. I'll see you guys tomorrow, like always, and a little bit later today on At the Close. But up next, we got the roadmap. So check that on out, guys. What do we got on the roadmap today? We're going to talk about Bored Ape update. We'll talk about OpenSea data leak. I did see that one. I think it's important to keep on watch these platforms. NFT market update, ENS domains, and I'm wondering what's going on in the NFT world. I know that they're struggling right now with cryptocurrencies coming down, but I have seen a little bit of stabilization. I'm wondering how the prices are going and what's going on with the top 10 projects. You guys can find out, of course. Stay tuned for next roadmap with Chris Ketchy. Go find on out, and I'll be back a little bit later on At the Close, and of course tomorrow with Stock Market Movers. BBIG Ray, I got you, man. Unfortunately, I don't have enough time to go over it today, but hey, maybe shoot me a message on Twitter. I'll go ahead and I'll do a personal look for you. I don't mind, Ray. Have a good one, guys. Thumbs on up. I'll see you guys on At the Close. Up next, you guys got the roadmap, and we'll keep it going right here on Benzinga.